Welcome to Sprott Media. I'm Albert Liu. U.S. markets continued to tumble as the Dow Jones Industrial Average heads for its worst week since 2008. On the line now to help make sense of it all is Rick Rule, President and CEO of Sprott U.S. Holdings. Rick, thanks for joining me. How are you doing?
Albert, I'm doing fine, and it's a pleasure to be with you. Interesting times.
Interesting times, and as we all start to work from home, it's been fun having a little tour of everyone's home offices. I'm going to credit you and Bonnie for doing a great job with yours.
Well, I have to say, the circumstance that is causing us to do this is unpleasant. The fact that I work from home and get to hang out with my wife, who I like to hang out with, is an unalloyed blessing. So mixed messages right now. Lousy excuse, not a bad outcome.
That's right. So I want to start with oil, Rick. At this point, $30 a barrel seems like a long time ago. WTI is now below $24 a barrel. That's what my script said, but I just looked down at my computer and I swear to God, Rick, I saw 19 for a second. It's back up above that, but this is truly extraordinary. And I can't help but think, as this war wages on, about the things I've read about Standard Oil back in the day, how Rockefeller aimed to put his competitors out of business by crushing the price. But what would happen is that the businesses would go under, but the assets and the oil would remain there. New management would come, and then he'd have to fight this new crew. So I'm wondering, do you see that kind of playing out with U.S. shale? Do you think that regardless of where this goes, we're going to still be around, we're still going to be producing oil, and this cartel is still going to have to deal with us?
We are still going to be around, but the truth is that the advance in U.S. shale production has as much to do with extraordinarily low cost of capital as it does to do with the advances of technology that have blessed the U.S. oil and gas industry. Were it not for excessively forgiving equity capital markets, which I think are over for a little while, and extraordinarily generous debt markets, which I think are over for a while, we wouldn't have seen the boom in U.S. production that we saw. We benefited in the United States from extraordinary oil and gas technology and probably equally extraordinary, but somewhat less benign, financial technology. The nature of the shale business is that it is extraordinarily capital intensive. And the advantages that the United States had in terms of its developed or maybe overdeveloped capital markets played an important part in the increase, the doubling really of U.S. production. And I think that the United States for a while is going to be a much less formidable competitor in world markets as a consequence.
But however, going forward, do you see the technology and the presence of at least the threat of this keeping oil below, $60 or $70 a barrel for the foreseeable future?
I think that the ability of the U.S. to produce may play a part in depressing oil prices for longer. My own suspicion, Albert, comes to the same conclusion, but from a different cause. And that is that oil prices were probably buoyed by a 10-year-long economic recovery. That is, the demand side for oil was stronger for longer than I had anticipated it being. And I would argue that a 10-year-old economic recovery was long of tooth. And that economic recovery itself, I think, was propelled at least as much by artificially low interest rates as by strong economic fundamentals worldwide. So my suspicion is that a longer period of weak oil prices will be less to do with U.S. production and U.S. technology and more to do with the weakening of demand on a global basis. A weakening of demand, by the way, not due to Greta Thunberg, greening, and electric vehicles, but rather a reduction of economic activity on a global scale.
This is an unusual circumstance of the world's most powerful producer cutting back at the same time that the world's most powerful consumer is also cutting back. Or sorry, they're increasing while we're cutting back. Some people are speculating that this is going to drive the spot oil price to zero or negative. And for those of us who are just trying to get our heads still wrapped around negative interest rates, this is an interesting curve. Do you see any possibility of that happening?
I do not, but the truth is that my track record as a price forecaster, like every other forecaster, is cloudy at best. Buffett famously said that predictions tell you a lot about the predictor and not very much at all about the future. The certainly the oil market that has the greatest potential to go close to zero is Canada, where, as a consequence of political decisions that were made, the ability to get oil to market is constrained. And there have been circumstances in Alberta where the price of natural gas, went to zero. And the circumstance of some continued production in Alberta at the same time that their markets are constrained, both due to soft markets, but also due to 10 years of political decisions, means in Alberta, you could perhaps see oil and gas prices approach zero as storage gets filled and product can't move to market.
Okay, let's move on from oil to gold. Gold appears to be holding up well, still below 1,500 an ounce, but it seems like cash, and specifically the US dollar, appears to be still where the priority is. How long do you think that that's going to persist?
I suspect, from the point of view of people listening to this, making the question non-esoteric, I think people need to own gold in this environment, and they need to hold cash, US dollar cash, in this environment. It is true that the actions that are being taken to alleviate the effects of our current economic situation will cause the purchasing power of US dollar cash savings to go down, sub-zero. In other words, your cash will be less a year from now, worth less a year from now than it is now. That notwithstanding, you need to maintain liquidity, because the liquidity will give you the tools and the courage to take advantage of what I see as a period of prolonged volatility. Now, the US dollar has proven itself to be relatively strong. That is to say, despite the obvious weakness in the US economy and US capital markets, the US dollar, relative to other fiat currencies and relative to other asset classes, have done well. Classical flight to quality. It's, I guess the right word is an amusing comment on the fragility of other financial instruments, that the dollar is strong, but that notwithstanding, the dollar is strong. It's worth dwelling on this for a second, though, Albert. It seems to me like the circumstance in front of the US dollar argues for increasing one's gold holdings. In the first instance, Congress and the president are finally united in the sense that everybody who votes is going to get some form of bailout. The bailout in the fashion of newly created liquidity. This is, as an example, the overnight repos and the greater quantitative easing. As you and I have discussed so many times in the past, Albert, quantitative easing is collective speak for counterfeiting. You create a whole bunch more currency units that are unbacked by anything. They are truly floating abstractions. They're just a better floating abstraction than the one that's offered up by the Europeans, the Japanese, or the Chinese. So that's on the sort of risk side. The risk grows, and it grows not just as a consequence of the debasement of the currency. It also grows because the balance sheet of the United States, the entity behind that floating abstraction, gets weaker and weaker. We have, as I've said so many times talking to you, $22 trillion in on-balance sheet liabilities at the federal level, and over $100 trillion in off-balance sheet liabilities. That's before state liabilities, local liabilities, and the net present value of unfunded pension plans. So the risks inherent in the US dollar, particularly the US dollar as expressed by US government securities, grows. At the same time, the reward offered up to you for owning US government securities goes to zero or sub zero. Return free risk. The idea that while you reduce the purchasing power of the dollar, that you are able simultaneously to reduce the risk premium that you pay to people to hold the dollar is nonsensical. But those are the times that we live in.
It does seem nonsensical, Rick, yet we're seeing this. And I'm wondering, on a short-term basis, I'm wondering if you personally, in your personal affairs or in your function at the company, would be willing to accept negative yield on a short term, because what we saw the Fed take short-term interest rates to zero, and then we've seen the market take short-term interest rates in the form of treasury bills negative.
Right.
And I'm wondering if on a short-term basis, it makes sense that if that what you describe as return-free risk is actually negative return security in some form.
The answer to that is yes. The negative interest rates are really the market forward shifting their anticipation of long-term interest rates. So to the extent that I had 90-day money, as an example, earning me a negative 25 basis points annually, I would consider that an opportunity cost. I understand that in a period where the VIX, the volatility index, is consistently above 40, sometimes above 70, that volatility is likely to be with us for a while. And not having sufficient liquidity that I could weather, or better yet, take advantage of that volatility is unacceptable to me. And I understand in the near term I have to pay the price.
Okay. I have another question, and I think this is a relevant question for all investors, and that is speaking to the health of the financial system. We saw the Federal Reserve launch a program whereby they're now going to be buying muni bonds, commercial paper, even lower grade commercial paper. And the question that immediately comes to mind is, who are they bailing out here? We're told that the financial institutions are strong. They've been handcuffed and stress tested and whatnot. But it seems like they're going to benefit from this. And I wonder, are they bailing out weak institutions, or are they fortifying these institutions because they're going to be used as a conduit to bail out someone else? Well, how do you see the strength of our financial institutions right now?
I think the answer to those questions is yes and yes. Weak institutions and strong institutions will be bailed out. The government believes that no institution can be allowed to fail, both because of the direct consequence of that failure on their customers and depositors, but also because the government rightly believes that business confidence is fragile. My suspicion is, in the near term, this incredible influx of liquidity is going to work in terms of preserving confidence. Most people would like to believe that the government is the solution, rather than understanding, as I believe, that the government is the problem. Most people want to believe that the big thinkers stick-handled or maneuvered our way out of the financial crisis in 2008, and that with skilled hands in charge, of course, voters differ as to whether the current administration represents skilled hands, but that's a different question. Most citizens, most voters, in fact, frankly, most investors want to believe. And if the government gives them the opportunity to believe, that is, if the government adds enough liquidity to the system that major cracks don't appear and that panic doesn't ensue, most investors want to breathe a sigh of relief, and most investors will do what they want to do. The question becomes, how long can this continue, and what will the ramifications of these policies be in the longer term? And by longer term, I'm not talking about decades. I'm talking about 9 months, 12 months, 18 months.
Okay, let's shift gears now to a topic you're going to like. That's the junior mining sector. The GDXJ, last I checked, down 38% year to date. Is that too much for companies that maybe the fundamentals have not changed that much and energy has just gotten cheaper?
I think it's very important to segregate when you talk about the junior mining industry. We've talked about this before too. There are probably 1,500 listings worldwide that purport to be in exploration, pre-development, or development, the so-called junior mining universe. And my suspicions are that not more than 200 of those are viable in good markets. So when you talk about the junior mining industry, I have to presuppose that you're selective and not buying the whole industry. To the extent that you are selective by buying the index, understand that the median market cap that you're buying was over $2 billion, which probably doesn't equate to most people's definition internally of juniors. It's also important to note that the ETFs that represent the junior mining index are being driven by leveraged ETFs, 2 times and 3 times leveraged ETFs. The volatility in the market has been so extraordinary that for the first time in my lifetime, at least, the share prices of the ETFs have not reflected the net asset value of their holdings. The market makers simply could not buy shares or sell shares or liquidate shares fast enough to synchronize the net asset value of the ETF with the markets for the ETF. I've never seen anything like this. It's extraordinary. I am not looking at the junior gold miners as a market. I don't consider the market to be a source of information or a financial product itself. I consider the market to be a facility. And there are certainly very high quality juniors in the market. Companies that are generating substantial free cash or have substantial amounts of free cash, so that are, at least in the intermediate term, not at risk for running out of capital, which they can't acquire in the market, that are selling at substantial discounts to what I believe they're worth. So I have been selectively buying the juniors. Selectively buying the juniors in the certain knowledge that they could fall 25% from here. But my belief is that money is made on the delta between what something is worth and what the market is willing to pay for it. And the best arbitrage in my life has always been the difference between people's near-term prejudices and the long-term realities of the market. Buffett famously said that the market in the short term is a voting machine, and in the long term, it's a weighing machine. So the fact that people have been indiscriminately selling bad juniors alongside good juniors with no expectation or thought of either what they're worth or what they are likely to be selling for the 12 to 18 month time frame, taking advantage of that has been beneficial to me in the past, and I'm confident it'll be beneficial to me this time too.
Rick, finally, regarding the finances the financings that some companies are going to need to continue their activities, what will you have to see? I assume that they're not proceeding now. What will you have to see, or what will have to happen for us to get back on course with that?
Well, a couple things. I think that you're going to see an increase in either debt or hybrid securities. Because companies are not willing, high quality companies are not willing or are less willing to issue equity at this point in time. So we see with the cost of capital going up, high quality issuers being more willing to give equity holders direct stake in the capital stack, meaning giving them security in preference to existing shareholders, and at the same time paying a yield, taking away the time value of money objection. So one of the things that we expect is that promising companies who have potentially catalytic events that are unfunded will be able to obtain the capital for those catalytic events, but they are likely as not to do them either with bridge loans or with convertible preferred equity issuances. Companies that have high quality development projects that have bankable feasibility studies will be able to obtain the debt financing necessary to put those projects in production. One lender I know very well is Sprott, and we have about $1.3 billion US in dry powder to deploy in that sector. So that capital will be available, but it won't be cheap. We, meaning Sprott, also will have equity available for high quality juniors. But it's important to note that that equity will reflect the risk which has always been present in the junior mining sector, and also the risk that capital markets will stay constrained. So when the company needs to come back for additional capitalization, that capital may or may not be available to it. That's all a different way of saying we still have capital available, but the price of that capital has gone up to reflect the fact that the risks involved in the sector and in broader financial markets have increased as well. Traditionally, Albert, in my life, these financial panics have been the source of most of my personal wealth. Traditionally, having cash when others haven't, and having the knowledge of how to deploy it and the courage to deploy it has inured to my benefit. But I need to say it has, in every case, caused me some alarm and concern along the way. And I wouldn't anticipate this circumstance being different.
Thank you very much. We're out of time, Rick. My guest has been Rick Rule, President and CEO of Sprott U.S. Holdings. Thank you, Rick. Look forward to meeting with you again soon.
A pleasure, Albert. I hope you're enjoying working from home.
Indeed. I'll be looking for some social distance from my family in a couple weeks, like everyone else, I think. Thank you.
Thank you.